The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. The Reserve Banks of Australia and New Zealand are both set to make rate decisions next week. We compare the hiking paths they've taken to date. And there's been another development in the UBS Credit Suisse merger. A CEO is getting the boot and an old one is coming back. It's Friday the 31st of March and you're watching Markets with Madison. The Reserve Bank of New Zealand is expected to ease off the gas. It's already hiked by 0.5% this year, but most economists are picking a 0.25% hike next week. If they're right, that would take the official cash rate here to 5%, still its highest level since December 2008. In contrast, the Reserve Bank of Australia hasn't even hit 4%. They've opted for smaller 0.25% hikes for the past 5 meetings. And it seems pretty effective. Aussie's inflation rate dropped this week below 7%. I caught up with HSBC's chief economist yesterday and asked him who he thinks has got it right.
Time will tell is the true answer, but what's really interesting right now is that they are taking quite different approaches to managing what looks like quite a similar problem. Both countries have got some differences between them, but primarily they've both got an inflation challenge. Inflation is too high, and both central banks have been lifting interest rates to try to deal with that, to slow demand, to get it to grow back in line with supply. But over here in New Zealand, the approach has been more about, we really need to get inflation down quickly, we're going to lift interest rates a lot, and that's going to deliver a downturn. And that's kind of where you are. I think you've already slipped into that downturn. And in Australia, the approach is, look, inflation's too high, and we need to get it down, but we want to kind of do that without necessarily delivering a recession. We want our cake and we want to eat it too. And so they're taking a more, cautious approach. And so hence, we're going to see, we think that the RBNZ lifts interest rates again by another 25 basis points, but we think the RBA probably is going to pause. And so there's quite a stark difference. And I think a lot of it reflects how they're reacting to the information, how they interpret their mandates, rather than differences in the economy itself.
Australia's inflation is cooling. It came in below 7% just this week. Does that suggest at all that the Reserve Bank of New Zealand didn't need to go as hard as it has?
I don't think that we can know that yet. I think it's still something that we'll be able to assess later on. I think both central banks, as I say, are taking different approaches. I think the RBNZ really wants to get inflation to come back faster to its target, and it's worried about the idea that the high inflation embeds itself in the system. And that concern is sort of driven by the fact that wages growth has picked up more here, and it is more in the inflation expectations measures here. So there's some validity to that concern. Whereas in Australia, we haven't seen the same sort of pickup in wages growth, and the RBA has taken this more cautious approach. But they both take risks, right? The risk here is you end up with inflation still remaining quite high because actually globally it is quite elevated, and you have the economic downturn. And the risk in Australia, so that might be not that great if that's how you land for a sustained period. The risk in Australia is they don't go enough, and then they end up with longer term inflation, and at some point they have to have a bigger downturn to get that down. So they have higher interest rates for longer and a longer period of slower growth rather than the sharper shock that you're likely to see here. So look, they are really quite different approaches, and only time will allow us to determine whether we think one is superior to the other. It's not going to be something you can judge ahead of time or even in real time, I don't think.
Now, I hear that you're a bit of a theatre man, are you, Paul?
I have been in the past, yes.
What do you make of the performances of the relative governors of our central banks, particularly their messaging to households throughout this rate hiking cycle?
Well, look, it's been a very tough time for central bankers across the planet. I mean, we focus on our own ones, of course, but it has been a really tough time. When the pandemic came along, the message was very, very negative. We were expecting a sustained period of very changed conditions and weak economies and so on, and both central banks pulled out all the stops, really. They really did. They delivered shock and awe. They threw the kitchen sink at the economy, so to speak, in terms of delivering monetary stimulus. And they used slightly different approaches, but there were a lot of similarities. I think for the RBA, the thing that they've learnt is that you want to be really careful about forward guidance. And in their case, they gave state-based forward guidance. They said, look, we think inflation's going to be low right out to 24, and so we don't think we'll be lifting the policy rate till 24. But even having spoken about 2024, it became the soundbite that essentially they would be holding rates out till then. And of course, that hasn't been how it's turned out. So it's been really, really tough for them, I think, in terms of, and they've learned a lesson. The lesson is don't even try to give time-based forward guidance. And I think the RBNZ, well, they delivered a lot of support, and now you're looking at an economy that's overheating. So I guess you could look at that and say, well, did you need to deliver quite as much? But on the other hand, they've also been one of the first central banks, or they were the first central bank in the G10 to start lifting interest rates, to start taking it back. And so, there are differences in terms of the approaches we've seen, as we've been talking about. Which one proves to be right is going to be a retrospective question. So it's difficult to judge their performances in real time. We'll see what it looks like in a few years' time once we look back on it.
One thing our economies do have in slight common at the moment is the rate at which house values are falling. What's your outlook for house prices in both economies?
So for both countries, it's a part of the transmission mechanism. If you lift interest rates, part of it is to get house prices to fall, slow down the economy, slow down the consumer. So that's one thing to keep in mind. There are also differences. So New Zealand had a much larger run-up in house prices through the pandemic. They rose by about 46%, which is extraordinary in such a short period of time. And so they really were a bit more overvalued. And so a larger correction was likely, and that's what you're seeing. So house prices nationally in New Zealand are already down 18%. I think they're going to fall a bit further because the RBNZ is going to lift rates a bit further yet. And so we think probably peak to trough a 25% decline, and that's a big decline in house prices, but it did follow a big rise. In Australia, they rose by less. They rose by 25% through the pandemic, so less, but they're still coming down, of course, and our forecast is that they fall by more like 15%. We're already down 10, so we're almost, we're a long way through it, but we think that they'll fall by 15 in total. So yes, bigger ramp up in New Zealand, bigger decline, smaller ramp up in Australia, smaller decline, but a lot of similarities really when you think about it.
I know that you do have some concerns about the financial stability issues that could come with such large house price declines in New Zealand. At what point peak to trough should be worried?
Yeah, well, so this is it, right? So it's not, there's no sort of threshold, there's no trigger level where you go, well, that's the amount, oh no, that's too big and that's not quite big enough. I don't think that's the way it works. But at the moment, the thing that's allowing house prices to fall without it being a really big, sort of bigger issue for the financial system is that there's lots of jobs out there and the unemployment rate is still quite low in both countries. Once the unemployment rate starts to rise, that's where it's going to get trickier. And because we do think that in both countries, in fact, you're going to see the unemployment rate start to rise as the monetary policy tightens and further yet, because of that, we think that you are likely to start to see some financial stability issues on the radar at least. We're more focused on the idea that that might be a bigger problem for New Zealand, in part because we think interest rates will go up more, in part because house prices are going to fall by more, and so we are really quite vigilant about watching these risks.
Unemployment has to rise, right? This is a symptom of the recessionary sneeze that we have to do, correct?
I think so. I mean, I think it's very hard to believe that you're going to get wages growth to slow down sufficiently in New Zealand in order to get inflation back to target without the unemployment rate needing to rise. Because how do you get wages to slow unless the unemployment rate rises? In Australia's case, maybe the unemployment rate doesn't have to rise quite as much because we haven't seen the same sort of acceleration in wages growth at this stage. It's been a bit slower.
How much does it have to rise by locally?
Well, this is again a very tricky question. We think that you're going to see a reasonably decent rise in the unemployment rate in both economies. For Australia, we think we might just escape with a downturn rather than a recession. And that reflected in less of a rise in the unemployment rate. In New Zealand, where the approach has been to deliver a sort of harder landing and a bigger tightening, we think you're probably going to see the unemployment rate rise by a bit more. It's not the only part of the story, though. We've talked a lot about demand. There's also a supply side dynamic we have to think about, and that is the border has reopened in both countries. And for Australia, the immediate effect has been really, really big ramp up in population growth. And that's delivering a lot more workers into the system as well. So the unemployment rate rising in Australia may very well reflect not just slowing demand, but actually a very big boost to labour supply. Here, you've reopened the border, but actually you haven't had that much of an influx of people yet. And so the labour markets might stay a bit tighter in the scheme of things.
This rate hiking cycle has been historic, absolutely. How do you think all of this will go down in New Zealand and Australia's history?
Well, I think that it's, we're going to look back and put this in the context of the big global shock, which was the COVID-19 pandemic. That's what we're going to do in history. We're going to go, well, there was this thing that came along, and it was a global pandemic. It was the first time we'd seen a global pandemic in basically a century, and these are the lessons we learned in terms of the policy response. Now, one of the things we did was we kept a lot of people in their jobs. We used a lot of very powerful policy tools, and if you think about that as a primary social objective from policy, then that's actually a really big positive in the scheme of things. But like other countries, on the way out of it, of course, we've had high inflation. And so one of the challenges we've had to deal with after this is to try to get inflation back down. Now, one of the things that may very well happen is it may turn out that a lot more of the reason for the higher inflation has been the disruptive effects of the pandemic. And that's kind of the good outcome, because some of those will disappear quite quickly. Inflation comes down a bit faster, it's supply related and so on. It may turn out that a bit more of the inflation is more sustained, and we may have to have bigger downturns. And I guess that's what we'll look back and say and see. And I think it will be, in the broader context, very much tied with, the impact of a global pandemic on an economy. And there are lessons learned along the way. But I think we've actually, in the scheme of things, come through it like in reasonable shape if you put it in that broader context.
Thanks so much for your time, Paul. I'm sure we'll look back at history together at some point soon.
I hope so. Cheers.
Let's take a look at what's happened this week. The ink has barely dried on UBS's acquisition of Credit Suisse, but UBS has already announced a new chief executive. Sergio Omotti will return to UBS to manage the transition, replacing Ralph Hamers as soon as next week. UBS said in a press release that the board made the decision in light of the, quote, new challenges and priorities facing UBS, and that Hamers has agreed to step down to serve the interests of the new combined bank and the Swiss financial sector. Omotti was the ex-chief executive of UBS for 9 years. Hamers has only been there for 2. America's First Citizens Bank has bought the failed Silicon Valley Bank off regulators to assume $56 billion of deposits and $72 billion worth of loans. Also, more detail on how Silicon Valley Bank collapsed was revealed in a Senate hearing this week. The Fed's Vice Chair of Supervision, Michael Barr, told the committee that the regulator was aware of its problems at the end of 2021 and raised concerns last year. The regulator met with SVB senior management as recently as mid-February. That's just last month. It was also revealed that it could have been worse. Depositors were set to withdraw $100 billion from their accounts the day after regulators stepped in. There was a bit of news on our market this week too. Synlait Milk revealed an 83% drop in its half-year profit to $4.8 million. The company's reduced its forecast demand for infant formula from suppliers, including its biggest, A2 Milk. Its balance sheet is also under a bit of pressure, with its debt increasing 32% in the half-year. Synlait's share price is down about 40% this year. New Zealand King Salmon also reported this week, and it's back in black with a $1.9 million profit compared to a previous $73 million loss. The company farms salmon in the Marlborough Sounds, which is heating up. It faced a mortality event in the first quarter. It's hoping for consent to move to a salmon farm in the cooler Cook Strait soon. And we broke a story yesterday about Trade Me possibly relisting on the NZX and ASX next year. Sources confirmed to me this week that Trade Me's private equity owner, Apax Partners, is looking for an exit, eyeing a preferred partial dual listing. Let me know if you'd be keen to buy a slice of the online marketplace if it goes public again, and what you think the Reserve Bank could or should do next week. Now go put your money to work.
Thanks for checking out our YouTube channel. To stay up to date with all the latest news from the New Zealand Herald, click the subscribe button below or check out one of the videos here, and head over to nzherald.co.nz for more details on these stories and more.